It's 2006. America is living the dream. Houses everywhere. Mortgages for everyone. Your neighbor bought a house. Your mailman bought a house. Your dog probably could have gotten a mortgage. Banks were handing out home loans like Halloween candy. No income? No problem. No job? Still fine. No pulse? Let's talk. 2 years later, that entire dream exploded. 8 million jobs, gone. $10 trillion in household wealth, vanished. Millions of families on the street. But here's the part they don't put in the textbooks. Some people knew it was coming, and they got filthy rich from it.
To understand 2008, we need to rewind to the 1990s. America was riding high, the economy was booming, and Wall Street was bored. When bankers are bored, they get creative, and when bankers get creative, nobody wins. Here's a simple version. Banks used to make money the old-fashioned way. You borrow, you pay back, they profit. Simple. But then someone on Wall Street had an idea. What if we could sell other people's debt as an investment? They called it a mortgage-backed security. A fancy term for we bundled thousands of home loans together, slapped a bow on it, and sold it to investors worldwide. Investors loved it. Why? Because someone told them these bundles were safe, AAA rated, the highest safety rating possible, the same rating as U.S. government bonds. Here's a stat that'll make your stomach turn. By 2007, Wall Street had created over $700 billion worth of these products, most of it built on loans that should never have been approved.
Okay, let me explain this with pizza. Imagine a pizza shop owner who makes amazing pizza. People love it. He gets paid. Life is good. Now imagine a bank walks in and says, "Hey, we'll buy every pizza you ever make, up front, today." The chef thinks, jackpot. He takes the deal. But now the chef has zero reason to care about quality. He's already been paid. So he starts using cheaper ingredients, less care, less quality. That's exactly what happened with mortgages. Banks would approve a loan, any loan, because they were going to sell it off immediately to Wall Street anyway. They got paid up front. The risk? Somebody else's problem. This is called the originate and distribute model. Or, as I like to call it, make the mess, leave before it smells. But Wall Street made it even worse. They took those bundles of risky mortgages, chopped them up, repackaged them, resold them again. Like taking 1,000 bad pizzas, shredding them, repressing them into one giant new pizza and calling it gourmet. They called these CDOs, collateralized debt obligations. You don't need to remember the name, just remember recycled garbage dressed up in a tuxedo. And the rating agencies, the companies paid to tell the truth, they kept stamping these products safe. Why did nobody stop this? Because everyone was making money. The banks, the brokers, the rating agencies, the investors. When everyone is eating, nobody asks what's in the soup.
But a few people were asking. Meet Michael Burry, a one-eyed doctor turned hedge fund manager. In 2005, he started actually reading those mortgage bundles, thousands of pages of loan data, line by line. What he found was terrifying. Millions of these loans were designed to be affordable now, but had interest rates that would reset in 2 to 3 years. Translation, millions of Americans were in loans they couldn't actually afford. So Burry did something insane. He bet against the housing market. He essentially said to Wall Street, "I'll pay you monthly fees now, and you pay me a fortune when this collapses." Wall Street laughed, took his money, called him crazy. A few others joined him. Greg Lippman, Steve Eisman, John Paulson. They all saw the same thing, a machine designed to keep running until it couldn't. Then, in 2007, the first cracks appeared. Homeowners with those reset mortgages started missing payments, then more, then millions. The value of those AAA-rated bundles started collapsing overnight. By September 2008, Lehman Brothers, a 158-year-old bank, filed for the largest bankruptcy in American history. The whole system froze. Banks stopped trusting banks. Credit markets locked up. The global economy held its breath.
What happened next was felt everywhere. Not just on Wall Street, not just in America. Iceland's banking system collapsed entirely. Greece went into a debt spiral it's still recovering from. Millions of Africans, Asians, and Europeans lost jobs in a crisis they had nothing to do with. In America alone, 8.7 million jobs lost. 3.8 million foreclosures filed in 2010 alone. The average American household lost $5,800 in income. And the bankers who caused it? The U.S. government injected $700 billion in taxpayer money, the TARP bailout, to rescue the very banks that burned everything down. Not one senior Wall Street executive went to prison. Not one. John Paulson, who bet against homeowners, made $15 billion in 2007 alone, the single greatest trade in financial history.
So was 2008 a mistake? A once-in-a-century accident? Or was it a system working exactly as designed, rewarding the people who understood the rules and destroying those who didn't? Because here's the uncomfortable truth. The rules weren't hidden. The data was there. The warning signs were there. A handful of people read the fine print and made fortunes. Everyone else trusted that someone was watching. New regulations came after 2008. Dodd-Frank, stress tests, new oversight. And yet, some economists argue the system today carries eerily similar patterns: derivatives, leverage, confidence built on confidence. The 2008 crash wasn't just a financial event. It was a lesson in who the system is built for. And whether we learned it is still up for debate. So here's what I want to know. If the warning signs are the same today as they were in 2007, are we sleepwalking into another crash? Drop your answer in the comments. And if you think someone needs to see this, share it. Because financial literacy isn't a privilege, it's armor. Subscribe. We post every week.